All right, everyone, welcome back to another roundup edition of On the Margin. Today, I am joined by my bicentennial co-host, Mr. Mark Yusko, and I'm giving you that adjective, Mark, because this is the 200th On the Margin.
Oh, awesome.
Yeah,
Awesome.
yeah,
Congratulations. And I have not been part of all of them, although the last year, we had our 1 year anniversary a little bit ago,
yeah.
has just been amazing. And congrats on the 200th version.
Mm.
And, I have an adjective for you. We're coming
Oh,
at you audio only
mm.
because of my intrepid co-host, little experience with some food poisoning over the weekend, which led to some incapacitation. So
Yeah.
as he recovers and recuperates, so maybe incapacitated, unfortunately, would be the right adjective today. But so we're gonna have to do the video. I mean the audio sock reveal. So I am decked out in the Bitcoin Friday pants. So I got my orange pants on, and
Mm.
I have my green Bitcoin bull socks on.
Love
We
it.
are squarely in a bull market, and we'll talk about why. But I did notice this morning. So hopefully my friends at Mount Socks are listening. I have a little hole in. I've worn them so much. I have a little hole in my Bitcoin bull socks. So I need an upgrade. But that is the sock reveal, and I'm ready to rock and roll. This was an amazing week. So much going on. So
An
much.
enormous amount going on. And yeah, it's audio. I wish we weren't doing the audio just for the 200th episode, but yeah, your boy's playing hurt this week. I've my friends know I've got a horrendous back, and yeah, that ran into not to give people TMI, but I did have a bout of food poisoning, and the vigor that I was discharging some of that food actually caused me to
There we
throw my
go.
back out. So
Vigorous. My
it's just
vigorous
yeah,
co-host. You are
yeah,
vigorous. You are
yeah,
vigorous in everything you do,
yeah,
and therefore it makes sense that vigorous would apply there. So yeah,
yeah.
that's good.
Yeah, but such is my dedication to the craft, and I couldn't bail on you, Mark. So I wanted to give the people a show anyway here. So I
I
thought
appreciate it. No sick days, baby.
no
No
days
sick
off, no
days.
days off, absolutely. All right, I've got a fun one to kick the charts off this week, which is this is the cover of The Economist. I don't know if you see, they're pretty.
Oh, of course, of
They're
course.
they are undefeated. So for those of you who aren't following along via video, the title is "Why Inflation Will Be Hard to Bring Down." It's actually I got to admit, for as good of a contraindicator as they are, they always do capture the zeitgeist. So they've got a a balloon that has kind of
Yes.
a nail in it. So they
Yeah.
really they went multi-dimensional on this artwork because they captured the whole UFO China balloon scare, but also they made it work with inflation. So we
And they
got
nailed it. And they
they
nailed it. And they nailed it.
they nailed it. So we did get we got a bunch of economic data this week. So we had CPI come in, we had PPI come in, we got retail sales, and we got unemployment. So basically, in terms of CPI, it wasn't a wildly unexpected print here. So what we're looking at, this is the month over month difference. Again, nothing to be really, nothing super unexpected here. The vast majority of what's still impacting core CPI is shelter, and we
Yeah.
know that there's a heavy lag to shelter, which is sort of weighing on the index. There was a slight beat in terms of the year over year CPI, but overall it was relatively sort of par for the course. I'm not sure, Mark, if there's anything that you wanted to kind of pull out of the CPI data.
No, look, CPI, as we have discussed over and over, it's just a bad indicator. I mean, it's
Mm,
bad on all levels. It's
mm,
manipulated because the goal is to keep it as low as possible because it's what is linked to entitlement programs. And then you have this unexpected COVID reopening problem, base effect, and they can't seem to do math very well and adjust for the fact that oil went all the way to negative and then trebled off the 40 normalized price, and used car prices went crazy, and so they for some reason they didn't strip that out. But okay, but now you got this owner's equivalent rent nonsense, which is yes, housing prices went up. Now I will argue, as I've been arguing, they didn't, right? Your money just got less valuable, and so that happened, past tense, and money supply growth went ballistic. And if you look at CPI with a 16-month lag, it looks exactly like money supply. Money supply growth has turned negative as of 6 months ago. So kind of a year out, not even a year. So if I 8-10 months out, we're going to have negative CPI prints. Now, will we get all the way there to deflation? I don't know, probably not. But I think we're absolutely going to be back to the sub 2% level by the end of the year. And it's really interesting. You've seen a collapse in used car prices, still high, but a collapse nonetheless. You've seen oil prices, basically be down year over year, right? Mm-hmm. They're actually not up, they're down. So if you think about that's good for quote unquote inflation. But there are some sticky price increases. Like we have a Shake Shack, which is awesome here in Chapel Hill, finally. And I've been going there a lot, and their prices are just stupid. I mean, the food is great; it's great, but their prices are just stupid, and they're not coming down. So I do think there is this. As much as I think the economist cover is wrong, that inflation is not going to stay high. I do think there are some components of cost in our lives which are going to be sticky down. And I think, restaurant food is one of them.
Yep, I agree with you on that. And I mean, we do know too that the Fed is trying to, they continuously kind of re-engineer or they create sort of different metrics that they care about. And we know that they care about core CPI X housing services, right? Because they kind of, the less charitable version is say they're trying to engineer a number that looks good. The more charitable version is they're trying to say, hey, we kind of understand the impact that shelter's having here. And again, if you're following along via video, you can kind of see this, shelter peaking, but they're pretty confident that's going to turn. So they're trying to kind of see through that part of the data and try to get an understanding, to your point, of how sticky really is inflation. And, I mean, there are, again, this is just another sort of data point here, but it's kind of interesting. This is, you can look at, again, if you're following along via video, you can look at, we've got US core services X shelter. So excluding that shelter component, you can kind of see categories here like medical care, transportation, recreation, education, etc. So you can actually see medical care has gone negative for the last couple of months. But there are still some kind of persistently sticky costs like transportation. And then on the right here, you're looking at the Zillow rent index, and Zillow rent and CPI, the shelter component of CPI, are highly correlated. But Zillow is just a more real time data, so it sort of tends to lead the shelter component of CPI. So basically, all signs are kind of pointing towards things turning over. It just hasn't necessarily happened yet.
Well, and on that Zillow number, again, it's corroborating what the money supply is already telling us, that by the end of this year, beginning of next year, we're going to have negative numbers.
Yeah.
And you look around at what is happening, and I think you were one of the first to bring this number out to people's attention. Was this, persistent bubble, I'll call it, of quote unquote savings post the stimulus checks. And while it had been cut in half, it went from 2 trillion down to 800 billion, there was still 800 billion on consumer balance sheets. And so everybody's crowing about the retail sales number earlier this week. And, it was such a great number. I'm like, okay. First of all, We had the warmest January in like a long time. I don't know exactly how long, but it was decades, like many, many decades. And it's not like it was super warm, like global warming warm, but it was warmer than average. And we didn't have any snow. I mean, we got no snow in North Carolina. I mean, not that we get a lot
Very
anyway, but
mild winter in New York too.
yeah, we got none. And because of that, they still, I just don't understand. They're supposed to seasonally adjust. And again, you got a lot of PhDs working on this stuff, and they never seem to get it right. And so first quarter always is wonky because it's weather impacted. And I would think they would have models at this point that would seasonally adjust correctly, but they don't. Anyway, so retail sales looked really good, except for two things. And this just drives me crazy. And I did a conversation with David Rosenberg on Wednesday. And I love Rosie. I mean, in fact, we should have Rosie on some Friday. He's just so amazing. And he's just been around forever and just really knows his craft. And, he was saying that the ridiculous part of this retail sales stuff is it's not persistent, right? I mean, it's one-time events, but more importantly, it's I lost my train of thought. Now I remember it's not adjusted for inflation, right? They report nominal sales. They don't report real sales. So they report this big increase. And the second thing they do that I point out is they don't adjust for population growth, which is absolutely insane, right? If there are more people buying stuff, you have to adjust, but they don't. And so someone actually pointed out on Twitter that, well, wait a minute. If retail sales were up, whatever it was, 6 point something, and inflation was 6.4, we have negative retail sales growth, right? And that's not what we report. We report a big number. Like, okay, fine. You can delude yourself into thinking that everything's great. But having to pay more for stuff, particularly restaurant food, which was the biggest component of retail sales, that's not growth. If I eat the same food, but it costs me more, that is not an increase in retail sales. It's just not.
The one small, not to because I agree with you there that I think the data should be adjusted that way. But I'm pretty sure even in the real sense, this was a pretty big beat on retail sales for this month.
I think it was, but again, I think that was a month-on-month effect.
It is month-on-month.
Because December was negative.
Yeah,
right?
and just to give people a sense of this is it was a 3% nominal retail sales, which is a big beat considering I think the prediction was like 1.9% or something like that. So when people are talking about real, we're doing inflation adjusted. So we're even subtracting out the 0.5%, which I think was month over month CPI. Then, that's how people are getting to even 2.5, which is even in a real sense, that's a big beat for 1.9%. I agree with you. I'm not sure what to make of it. Like, setting aside for a second, maybe this data isn't being portrayed in necessarily an accurate light. How is the market digesting all this? Because, we're still in, I think, a good news is bad news sort of paradigm while people are worried about inflation. And what I mean by that is when hot economic data comes back, it causes concern because it gives Powell more leeway to hike rates, right? Or it suggests that we might not have conquered this inflation problem, right? So we got so the CPI data that we got, again, it was roughly in line with expectations for month over month, which it came back. Core was 0.4% month over month, and headline was 0.5. That was right in line with expectations. On a year over year basis, it came in slightly hotter than people were predicting. It was 5.6 and 6.4 versus estimates of 5.5 and 6.2. But we had PPI come in this week at 6%, which was hotter than the 5.4% that was expected. The retail sales was a little bit hotter than expected. And the job report, there was slightly lower claims than was expected, 194,000 versus 220,000, which was expected. So all of these kind of signs, no huge beats here, but everything just came in, I think, a little hotter than people were expecting, which causes people to think that, hey, maybe we haven't actually beaten this inflation. And you saw bond yields respond exactly how you might think, right? So there's a big hop in the 2-year, which you're seeing over here on the left side of things. So we're right in between 4.6 and 4.65%. And the yield curve, as measured by the 10s and 2s, just continues to go lower into inverted territory. So all of that kind of spells trouble ahead. But the question, this is what we were talking about right before we got on, is if stocks aren't responding like that. The bond market is responding exactly how you might think it should respond. But stocks have been curiously resilient in the face of this economic data. And it's just funny to watch, so sorry, on the left here, you're looking at the S&P 500 and NASDAQ futures. So, you've got stocks climbing at the same time as you've got the terminal rate, which is the market's expectation of where rates are going to end up, climbing. And so now we're back above 5% to 5.29% in the implied terminal rate. So how do you explain this? Because this seems like contradictory data to me.
Well, okay, yes, and it's absolutely great observation. But I think there's a couple things you have to parse out, which is the time. So from the beginning of the year to a few days ago, basically the terminal rate was falling. The expectation of the terminal rate was falling. Everyone was convinced the pivot was here. And we had two things that are causing, or that caused, again, past tense, caused one of the great melt-ups of recent memory in January and the first, call it 10 days of February, which was, China and the Bank of Japan, my buddy, and now he's outgoing. I mean, crazy Kuroda-san, the sun is going to set on crazy Kuroda-san. They just elected a new central bank head, and it's just very sad. But Kuroda-san unleashed a Kuroda tsunami, the largest increase in money supply growth in his tenure, which is saying something. And the stat that I just love is in 4 days, I think it was December, he reversed all of the QT that the EU and the US did in 2022. Yeah. So in 4 days, okay. Then on top of that, right, as great as that tsunami was, heading towards our shores, China, basically the PBOC said, Kuroda-san, child's play. Trillion with a T, a trillion of new liquidity. And they've now said they're going to do 3 of those babies. Now, in 2016, they saved us from recession globally. Remember when oil prices at $26 and everybody thought the world was ending, and they stepped up and printed 4 trillion and saved the world. So they're trying again. And all of that liquidity came crashing into Silicon Valley, West Coast on January 1st, and caused the greatest short covering in history, right? In a 12-day period, more shorts were covered than any other time. And so we had this massive melt up, but all the short covering is over. And so what you've seen in the past couple of days is, okay, this good news is bad news. Okay, things are hotter, like literally hotter. January was hot. And the market's going down. So I think what you're going to see is kind of a gravity effect taken over. And unless crazy Kuroda-san and the PBOC, I actually don't know the name of the PBOC head, which is interesting. That's the way I like it. I like not knowing the names of central bankers. I think we shouldn't know the names of central bankers. In fact, I just retweeted this morning this amazing, and it's a little long, but it's this amazing video that somebody did on CBDCs.
Mm.
and you got you got to watch it. I mean, it's 5 minutes, so like I said, it should be 3 minutes, but it is. It just goes through all of the dystopian reality of central bank digital currencies, and but one of the main points is why do we hang on every word of this small group of deified people, Ms.
Mm.
Lagarde and Jerome or J or the letter J or whichever one he is. It's crazy. I mean, it's literally crazy when we
Mm.
could have a, you know, uh, codified, immutable monetary policy that's global, that's accessible, that's fair, and can't bribe Bitcoin. You can bribe central bankers. You can I mean it was just a very well done video, down to the testimonials, which I thought were hilarious. But all of that comes down to me to say, look, if people want to believe that we're going back to a world of easy money and Fed and other central bank largesse, and therefore you can justify higher PEs, God love you. I think that's a horrible way to invest, because all of the economic data, whether it's the Empire State Index, which just set a new all-time low,
Yeah.
whether it's the prices paid forward index, which is collapsing to levels we've only seen at like really bad recessions, like the Great Recession and the Great Depression. Leading economic indicators are collapsing so hard it's almost painful to watch, and earnings estimates are collapsing. So the only thing that's saving is short covering and PE multiples rising. That's just not a good way to invest in my mind.
Mm. So basically, if I had to sum up that statement, or your kind of thoughts there, is there's the reopening and sort of the liquefaction that's going on in China, and the PBOC, right, which is kind of boosting markets globally. And then maybe this is not necessarily something that's long lived, right? Like ultimately,
Yep.
if we wanted to get comfortable with this expansion, then we'd like to see some fundamental economic data backing it up. But all the forward-looking economic indicators, earnings, like those kind of fundamental things that would give us confidence in this rally, basically aren't there. Is that a fair summary?
Absolutely. And look, I'm you know me, I'm a fundamental value person, and look, and that doesn't make me good or better than somebody else who has a different view. It actually is a handicap for much of the last 20 years. It's actually been a real handicap, because I can't look at Apple, at this crazy EV to EBITDA, a company that hasn't grown their total net income in the last couple of years, and think it's a good thing to own. I just can't. I mean, I love their product. I'm actually getting a new MacBook Pro today, and they're delivering it. So I believe in the products, but man, the price of the stock is ridiculous, and it's because of passive indices, and there's 7% of every index, and every time 401k money goes in, it has to buy it, and I get it, okay, but I think it's hard, if you do focus on fundamentals, to be excited about equities, broadly. There are individual companies you can get excited about. I mean, there are some individual stocks in Europe that I think are really interesting. There are some interesting stocks in Japan, particularly the financials, because there appears to be, for the first time in 40 years, signs of economic growth and inflation. That's good for the financial. Now, they've already gone up a lot, so I'm not saying they're going to continue to go up as much as they have, but it's been 40 years. They've been down 80%. Just let that sink in. For 40 years, if you held Japanese bank stocks, you lost 80% of your money. Now, Could we go to only down 70% and be up 50, 60, 80, 100%? Yeah, it's possible.
What's going on, guys? Want to give a quick shout out to this episode's sponsor, Curve. They are the one-stop shop credit cards that helps you take control of your personal finances. Here's the reason that I personally love this company. These guys are all about helping you manage and maximize your personal cash flow. We have been talking for the last couple months about everything that the Fed is doing with raising interest rates. Obviously, no one's got a crystal ball. This is not financial advice, but I think it makes sense more than ever now for companies to be managing their cash flow and for you as an individual to be managing your personal cash flow as well. Curve makes it super, super easy to do that. Even I can do it. As the technological Philistine, they aggregate all of your spending information in one place. They make it super easy to plan. But they actually go one step further than that. They have a very cool feature called Go Back in Time, which allows you to switch payments from one card to another. So if you have an unexpected expense crop up, boom, you can move that over to your credit card, free up some cash. Or maybe you learned too late that you could have earned more rewards by spending on a different card. Boom, Curve has you covered there too. And the last thing that I'll say is, if you click the link at the bottom of this episode, you'll get $20 in Curve cash, but you'll only get that if you click the vanity link at the bottom of this episode. Plus, that gives me the credit as well. So thank you, Curve. I appreciate you caring about cash flow. Guys, click the link at the bottom of this episode. Tell them I sent you. Yeah, I think you might be right. I'm searching for this. There was a great tweet that I think Michael Batnick did, and or this is Ben Carlson. Sorry. And
Yep.
It's a great. It's basically, this is the tweet. The Great Depression turned an entire generation into frugal misers. The pandemic turned us all into raging spenders. And I think the point that he's trying to get at is that, it takes a long time for you to change your frame of reference about something. Like
Yep.
you can implement a system with poor incentives for a long period of time, and people can learn those wrong incentives. And it happens across like every level, right? Like, let's say it's kind of the same way. It's kind of just a different way of framing what people say in business, especially in Web 2, of like, you're at the mercy of your stupidest competitor. And what that means is, if you're competing with someone that spends like a drunken sailor, but when times are good, they have access to an infinite well of capital, they can do these things that make it seem like they're winning from the outside, right? Because they're just spending. They don't care about unit economics or profitability. So it looks like they're gaining all this market share. All the employees over there are like, yeah, we're winning here and here.
Look
and
at
here.
Stripe. Yeah, to that point, look at Stripe.
This can go on for years.
They just burned $500 million.
Yeah.
In a quarter.
Yeah.
In a quarter.
Yeah.
They burned $500 million.
Yeah.
And yet, if they went out to market today, they could raise it at whatever valuation they want, because everybody loves the narrative and everybody loves, it's like 11 lines of code or 7 lines of code or whatever.
Yeah.
Oh, great. Okay, fine. But if you can't monetize it, actually, and you can't actually make money, I mean, there are so many. 40% of the Russell 2000 don't make money.
Yeah. Think
about that. Yeah. Almost half of the companies don't make money. And I got news for people, right? Capitalism only works when you make money. Mm-hmm. It does not work if you're spending other people's money. That is actually something called communism.
Well, it's exactly to your point about how crazy it is that we all kind of worship at the altar of this very small group of people. You can sort of think of what the objective of what the central banks tried to do during COVID, right? And there's honestly good reason for them to do this. Is they don't want people to panic. They want you to go out there and spend money. So you can almost view this is like a lab type experiment. And, there's the doctor, right? Or the person in the white lab coat looking in at the little rat is the Federal Reserve and central banks. And they're pressing the Skinner box to get us, the rat, to do an action, which is to go out and spend money. And It turns out, like, once you reinforce that interaction in an animal, in a rat, it's very hard to unlearn that behavior. And that's why that's what's difficult right now, is the central bank has changed their mind. They say, okay, little rat in the cage, it's time for you to not want the the cocaine or the food or whatever that we've been training you to want. And people at every level, it's funds, It's companies that got drunk on debt. It's individual people that thought they were going to they got used to transfer payments and life on easy mode. And it just takes a long time to unlearn those behaviors that was the explicit policy objective and goal of the Fed to kind of push out. So I don't know. I thought it was a very succinct way of describing a phenomenon, which I've kind of been observing, but haven't really been able to put my thumb on.
No, and it's a great point, and it is a generational thing, right? That issue with Japan, right? It's generational, right? 30, 40 years. This doesn't change in 3 or 4 months. And look, I show this or used to show this great chart that Lacey Hunt put together. Again, another great mind. In fact, he and Rosie are doing a webcast next week. But Lacey had this chart, and it showed, post the Depression, debt was abhorred. I mean, debt in every sector of this country: government debt, corporate debt, personal debt. I mean, Depression babies did not use debt. They bought things for cash. They did not use credit cards. And then I show the chart. It inflects in 1981. It inflects and basically goes 60 degrees to now we have the highest level of debt in history. And I always hold up my credit card and I ask people, what is this? And they're like, oh, it's a credit card. I'm like, nope, it's a debt card. How much would you use it if it was called a debt card?
Credit
right?
sounds better, though.
We used to send people to debtor's prison.
I know.
Now, if you have a big credit line, you're a big man or a big woman, right? It's amazing, right? Credit is this weird kind of reframing of debt. And the more you have to, and to be fair, the system, if you want to get back to, we always have to go to Sinister Saturday. If you want to go to the sinister piece of it, that was the whole plan, right? The creation of the Federal Reserve in 1913 started a series of events designed to strip the wealth from those who could not get debt or credit. Okay. The average person with a fixed income or minimum wage job could not get credit, and therefore the rich people got credit. So what do? You have an inflationary bias that increases the value of the assets that you buy with debt.
Yeah.
And strips away the wealth of the masses and creates the largest wealth and income inequality we've ever had in history. And now you're showing this picture about the best spenders in terms of debt are the government.
I saw this article come out this week, and I have to. It made me angry. It did make me a little angry. And
should.
So I found this before. We've talked about it on this show. We've looked at the estimates that the CBO, which is the Congressional Budget Office, have for what the deficit is going to be over the next 10 years. And it was clocking in at $1.6 trillion per year, which I thought was nuts. This Wednesday, that's actually been revised up. Yeah. So now it's going to be roughly average 2 trillion. Deficits are going to average $2 trillion annually as tax receipts fail to keep pace with the rising costs of Social Security and Medicare benefits for retiring baby boomers. Now, I'm just going to translate that, because one thing that is infuriating to me as a line is when people in this very condescending way say that the way that governments are financed and household finance are not the same. Okay? So let me translate these words. Tax receipts are revenue, and Social Security and Medicare benefits for retiring baby boomers are obligations. So what this has said is that even at a $2 trillion deficit, our revenue is not going to be, does not match up with our outstanding obligations. And by the way, you can't print Social Security. You can't print Medicare. These are obligations that you owe to people, right?
Mm-hmm.
This is healthcare that you can print all the paper in the world. Someone out there actually has to go out there and administer the healthcare. And you cannot default on this, because if you do, you're going to have an entire generation of people that are out in the streets rioting. So, I understand. I understand that there's a difference that the US government can print money, but also at a certain point, you have real obligations that you either can't print your way out of, or the solution, which people aren't saying, is just debasement. And so that there is a consequence, right? There is a consequence to this. And now I feel like I'm getting a little emotional going on this rant here, but it's so frustrating. I don't understand why more people can't see this. Debt matters. It's the craziest idea to come out of this whole 0%, this 0% ZERP, weird strain of thinking. The weirdest thing to come out of that is that people have somehow concluded that debt isn't real or it doesn't matter. Sorry, rant over, but like it's
no.
It's
not
idea.
over. It's just starting. An entitlement, right? An entitlement is a promise that you make to yourself that you don't fund and you ask your kids to pay for.
Yeah.
Who wouldn't do that, right? So what's the average age of Congress today?
I actually don't know, but I would guess it's been going up. I've seen the charts.
Yep.
I know it's going up.
Yep. I think it's close to 70, right? I think it's close to 70.
No
and
way.
Oh yeah, I think it is. I don't know if that's exactly right, but I think it is. So it's probably not right. That's probably not the average. There's probably some other, but there we go. So here's the thing. If you think about the number of octogenarians, septuagenarians, sexagenarians, 60-year-olds in Congress, right? And they're the beneficiaries of these entitlements, and all of and this is the tricky part. Who votes the most?
It's the
senior citizens.
Yeah.
Senior citizens. And it's not even close, right? It's not close. So if you want to get elected, you have to
64.
60s.
Right. Yeah.
It's not quite 70.
It slates older for the Senate. The House is 58. I mean, that's still not young, but it's So 64 is the average age of a senator.
So, and my point there is that is clearly boomer. So boomers are in control, and they made these promises to themselves, and they didn't fund them, and so now they got to figure out a way to pay for them. Well, if you can't pay for them, what do you do? I mean, you literally just make the money come out of thin air. This is the cult of Kelton, the MMTers, and it's so ridiculous, because now I'm going to get you really angry. All right. If we're going to print 1.9 trillion a year, well, why don't we just print 3? Why do we collect any taxes at all?
Yeah.
Right. I mean, why do we collect 1/3 of what we need? And that 1/3 disproportionately attacks the middle and lower classes, right? Yes, they pay a lower percentage, but every dollar that they lose causes stress, like real stress. It was, tax the billionaires, 15%, 20%, 30%, whatever the number, doesn't matter, right? It doesn't matter. Their life does not change. And so, and yes, wealthy people pay a disproportionate share of the total taxes, but why do any of us pay any taxes? It just doesn't make any sense. If you're not going to balance the budget, taxation is kind of a weird dynamic. So, but here's the real problem. If, capital I, capital F, if it were true that you could create wealth by printing money, then every country would just do that. The problem is every country that has tried to do that has failed. Every single one.
That's the other thing that it's just, sorry, I know I'm going on my lane of frustration here, but when people say that, government financing isn't like household financing, yes, but what history would suggest is that it takes a lot longer than everyone thinks, but after a certain period of time, debt matters even for the dominant empire, the hegemon of the day. And usually, when you're looking at what made an empire fall, various different reasons, right? Like just try digging into like why the Roman Empire fell. It's very difficult to isolate any one factor, but debt and it certainly was. And Rome, they had the mint, right? They had the treasury, they had the mint in the center of the city. So it wasn't, that different of a situation, even back in ancient times.
It's just the age old issue of at what point does the graft and corruption become unbearable for the masses? And again, back to this video that this guy made, debt slaves, right?
Mm-hmm.
That's what we all are. We're debt slaves. We're slaves to our masters because of fiat. And when you can control the value of fiat and you can devalue the ownership share of the masses and funnel it up to the people at the top, which is what every empire in history has done, at some point, the masses say, nope, no mas. And then the empire falls. And there are no exceptions. That's the funny part, right? There are no exceptions.
It's undefeated.
Yeah.
And, we disagree slightly on that. I don't think there's a cabal at the top that's engineering all this. I think it's a set of broken incentives. And what I do believe is that there's a small group of people. There is a small group of people, obviously, who make decisions that really matter, that probably for well-meaning, right? Like even if you just look at how the COVID pandemic was handled, it's very hard to go back. And I can see myself even, if I was in the room making decisions at the Federal Reserve, the trade-offs of, you're faced with this vast unknown, right? The entire world and global economy is going to shut down. We don't know how bad this virus is going to be. No measure, what measure would you not sacrifice in order to stop that? But the problem is when you stack those incentives one by one over time, it kind of lines up with this pattern that we've seen repeated in history time and time and time again. And that's the concerning thing to me. And I think there's a period of time where we say, hey, the decisions that were made, the structures that we had, the way we've organized our institutions were really good for a certain period of history, but we need to make big changes going forward. And to your point about you can't print money and create wealth, I'm actually going to borrow I don't know if you watched the Gary Gensler video on staking, but to borrow his own metaphor, if you cut one piece of steak in 3 pieces, you don't have any more steak. And I think that's the thing that's very non-intuitive for people, at least for me in the beginning, about printing money, is that you think, well, obviously, if you print more money, you have more wealth. No, you don't. You've just increased the denominator. That's all you've done.
So you just devalued the currency. And
right.
And look, it just takes more dollars to buy stuff.
Yeah.
And it's kind of funny. And look, I really do. I love your positivity and your belief that things are fair. I absolutely love those traits. That's why we get along. But I'm just old and I'm jaded. And look, I can show you the chart of the Bilderbergs, and I can show you that, Bilderberg members control every major company and government in the world. And it's just the cross pollination of those individuals. And it's a very small number. I mean, we're talking, a few hundred people are on the boards of every major corporation, every bank, every government. And I really do wish it was just, bad incentives encouraging bad behavior. But I actually think it's bad people doing bad behavior. But, topic for another day.
What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. They can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount. Link is in the show notes. Sign up now. Thank you later.
The Bilderberg chart's actually pretty wild. Everyone can just Google BILDERBERG group. I do want to just conclude here by talking about crypto a little bit, because there's, the big concern over in crypto is regulation, right? So we've actually kind of got a couple of different conflicting sets of news over the last couple of weeks. So the topic that is on everyone's mind, right, is what it seems like, and I've spent a good amount of time the last couple of weeks talking to people, but basically it looks like this administration has sort of given the green light to regulators to crack down much harder. And honestly, I think, putting my pragmatic hat on here, this industry has a little bit of egg on its face because of SBF was kind of our voice in Washington, and he embarrassed a lot of really powerful people. So, no comment on that, but like that's how this stuff goes. So the SEC filed a probe into Kraken, and the result was they paid a $30 million fine and shut down their staking program, albeit there were some ways that Kraken was running that staking program that were, shall we say, non-standard, or could potentially fit the definition of, something that looks more like a security, right? Because the yield that people were getting from the product were more from the efforts of Kraken necessarily than the yield that was getting generated from the underlying protocols. So there's a little bit of mechanics there, but Paxos was issued a Wells notice from the SEC, which is a big deal, based on BUSD, which, according again to this was from the New York Department of Federal Services.
Mm-hmm.
There was the consideration that BUSD is a security, and now it looks like one of the other developments that came through this week was that the SEC is basically, they've got a proposal out there, which is the SEC voted on Wednesday. It was 4-1. Hester Peirce was the only dissenter to propose a rule that would expand the types of assets that investment advisors, such as hedge funds and pension funds, are required to hold using qualified custodians. So qualified custodian is a very specific definition when, as defined by the SEC.
Mm-hmm.
The challenge is that even most VC funds, I mean, Mark, I'm not sure if you're a VC or an RIA, but my understanding is if you're going to hold a bunch of liquid tokens, most funds are structured as registered investment advisors these days. And the challenge is, even if there's, I think, still a question if, Coinbase or Anchorage, fit the definition of a qualified custodian, even if they do, they don't today, and it's unrealistic to have them offer the long tail of crypto assets. So basically, what this would do is limit, it just kind of chokes off kind of the longer tail of crypto assets from any form of institutional capital, right? If it can't be custodied at a qualified custodian. So it's kind of just another way of sort of limiting. It's just another obstacle, basically, that people need to jump through.
Then they fight you.
Mm-hmm.
Look, and I know you and I have differing opinions on this of how coordinated and how planned this all was. But look, I've been talking about this for a year.
Mm-hmm.
This has all been part of the plan since day one, and they've been very, steady and measured in the execution of that plan, and execution intentionally used. You said it right. This is Operation Choke Point. This is about choking off access to capital markets, and it's about fomenting the FUD, right? The fear, uncertainty, and doubt. It's about criminalizing these assets, and in the eyes of the average user, and look, the bottom line is, first they ignore you, then they laugh at you, then they fight you. And when a couple $1 billion left the banking system to play around with magic internet money, no one cared. Nobody cared. When hundreds of billions of dollars left the banking industry to go into crypto, people cared. And those people now are using regulation, quote unquote, any regulation, right? They're not actually using regulation. They're using enforcement. There's a big difference. They are manufacturing, reverse engineering charges against people. And it's so insane, right? It's okay, here are the rules. And then you play by the rules. And then ex post, a year, 2 years later, they say, well, yeah, okay, you played by the rules. But here's the thing. We didn't mean those were the rules. These are actually the rules. And therefore you violated the rules. I'm like, but those weren't the rules. Those are the new rules. But you still violated them. So pay us. And like, well, but we didn't do anything wrong. Why would we pay you? Well, because if you don't pay us, then we shut you down. But that's extortion. I mean, that's literally, if you look up the definition of extortion, that's what that is. And look, I don't want to get shut down, so I probably shouldn't, call the regulators of me extortionist, but I actually think they are, and I really, this is right into Sinister Saturday. I think this is 100% a sinister plot to, basically pave the way for the introduction of pure evil. CBDCs are pure, unadulterated evil. It's social credit wrapped up in a nightmarish fiat digital asset that's centralized, controlled, and you are at the mercy. I mean, just the absolute mercy of these elites. I mean, imagine, right? I said, it's Friday, it's payday, and you get your money and you drunk tweet about the president and your money doesn't work the next day. Or, you did something wrong and your quote unquote score goes down. I'm just diversion for a second. Everyone knows FICO, right? And it's funny, I did not know that there's actually a company called Fair Isaac that created the FICO score. And everyone should pull up this stock. I mean, it is an absolute money machine. It's one of the best performing stocks of all time. And it's because they basically created a system that the elites love because it suppresses the masses, right? I are completely controlled by this little score. And I'll tell you a fun thing. So 10 years ago, I, for whatever reason, I don't know why I did this, but I did. I signed up for a 10-year ARM mortgage. And so it adjusted here, and I wasn't paying attention because I'm an idiot, because I don't pay attention to that stuff. And I got this notice that my rate was going to go from 3% to 7%. It's a big jump. Yeah. So I'm like, I don't know, I'll just refinance. So I go out to refinance and like, you're a self-employed person. I'm like, well, what do you mean? Like, well, you own this company and that's not good. I'm like, but my income's fine. I'm like, well, but it's not W-2 income. I'm like, so you're telling me that it's better to be a $50,000 a year W-2 than, hundreds of thousands of dollars of self-employed income. Absolutely. Well, then the killer came. Oh, and your FICO score, it's just not that good. What do you mean? I don't have any credit. I don't have any debt. I'm like, well, that's the problem. And at Christmas time, I bought some stuff for Stace at Athleta. And they said, oh, if you sign up for a credit card, we'll give 20% off, and stuff's really expensive there. So I said, all right, fine. I'll take 20% off. Well, then I closed the credit card and I go, oh, geez, that's the worst thing you can do. Like, what are you talking about? So
I agree with you. I think that, that you could almost trace to, there are some almost philosophical ideas that have been baked into our financial system. Like owning a home is good. That's not like a physical fundamental law of the universe. That is something that the United States decided, right? It's kind of in our DNA from Manifest Destiny and all that stuff. And we've just decided owning a home is good. And it's funny. I mean, if you reframed owning a home to you're going to concentrate 95% of your net worth in one asset that you are extremely leveraged on, most people would say, hey, that's not a great idea, but that's what owning a home is. And it's very similar with debt. This goes back to Alexander Hamilton, who his idea was that some small amount of debt is good. And honestly, that idea, that philosophy, like inked its way into the way we analyze credit and what makes you a good creditor or debtor in the United States. It's just funny. But I do want to get your take on, there was one bit of good news, because crypto has been remarkably resilient to a slate of bad headlines about regulation. And one of the bright spots is that there was a Wall Street Journal article that was run on Binance. So the headline here is crypto giant Binance expects to pay penalties to resolve U.S. investigations. So the DOJ, CFTC have been probing the world's largest crypto exchange. Their head of strategy, a guy named Patrick Hillman, came out basically and said that the company has been working to fill gaps in its early compliance efforts and expects that regulators will impose fines for past conduct. So basically, he said, the outcome will, quote, likely be a fine, could be more. We just don't know. That's for regulators to decide. It looks like it's going to be a relatively large fine, but I think the market was certainly worried about much more than a fine when it came to Binance. So a civil outcome here, as opposed to a criminal outcome, even if it's a gigantic civil outcome, would be huge, because it's kind of removing big bits of risk from the market. And if we go back to this sort of, we did an episode, I think a month and a half ago, of the 3 risks that are still remaining. It was kind of Genesis, Binance and Tether. And now the DCG, Gemini situation has been resolved, kind of. It looks like there's some sort of agreement there, which I'm sure no one's truly happy, but I guess that's what makes a compromise. And now if Binance were to pay a civil fine here and not a criminal one, then that would remove another big risk from the market. So I don't know if you have any thoughts there, but maybe just because this is the 200th episode, we could end on a positive note here.
No, look, I think it is incredibly positive in that the world's largest exchange, and look, there is a day in the future where exchanges are less necessary, when we can have a pure DeFi or a pure Bitcoin world. We're not there, not even close, but someday. So in the interim, we need some viable exchanges, and the idea of, everybody's like, well, FTX was the second. No, they were never the second largest exchange. No, they just weren't. So fake, but they were still a big exchange, and they failed, and what we saw was a resilience in that there are 500 exchanges. It's not like when Mt. Gox went down and there were a couple. So, but threats around Binance, having challenges were real. And so I agree with you that a civil penalty would be much better. And although I do find it interesting, again, back to extortion, this is a global business. It's not a U.S. business, and they have a U.S. arm. But for people to think that they can, censor a Chinese national living in Dubai running a global network, that's like the whole nature of crypto. It's nation stateless. But that's a positive. And look, Bitcoin's up 10% since we talked last week. It's up 13% in the past month, and it's up meaningfully from the bottom, kind of 50% from the bottom post FTX. So massive resilience. A lot of people starting to look toward the halving early next year, and crypto spring is getting long in the tooth, and we're only a few months away from crypto summer, and I just don't think people are ready. I saw somebody say, "Are you ready emotionally for $100,000 Bitcoin?" I don't think people are. I really don't. I don't think they're ready to see the next bull cycle, which is as inevitable as spring turns to summer and night turns to day. It's going to happen, and all the fundamentals. Back to fundamentals. I love fundamentals. Hash rate all time high. Number of wallets greater than 0.01 all time high. You got the whole new thing on ordinals and things being and NFTs on Bitcoin. Really hugely positive. And look, this goes to, are we going to live in a single chain world? Is Bitcoin going to be the chain to rule all chains? Are we going to be in a multi-chain world with bridges and interoperability? I don't know. I still don't know the answer to that. But I think that the inevitability of digital assets is stronger than it's ever been. The positive energy around the ecosystem is starting to come back after being suppressed. And look, are they going to try to beat it out of us more? 100%. There's more bad stuff coming from our buddies in Washington, and probably some doozies. There'll be some big fines and some big censures, and but in the end, I think this ecosystem is incredibly resilient. It is designed to be resilient. Decentralization is by its very nature designed to be resilient, and that's why I'm so comfortable staying the course and continue to make progress.
I agree with you. So, all right, Mark, I know we're running over time here, but this was a really fun one for 200. And even though maybe it didn't seem 100% like this throughout this entire episode, I remain very, very positive on things. And I feel super lucky and privileged to work in crypto as an industry. I think it's not always the most steady, predictable, reliable industry, but that's also what makes it fun. And that's why it grows really quickly. And things just, you almost take for granted working in this space, how much actual innovation happens and the velocity of new ideas. And I can't imagine working anywhere else. So
100%. And look, if everything was super easy, then everyone would do it, and the alpha would disappear. It's not easy. And that's what creates the opportunity. And innovation is all about overcoming obstacles, right? Necessity is the mother of invention. So when there are obstacles or inefficiencies or negative externalities, innovators throughout the years have come up with ways to overcome them. And every time there's an obstacle or an incumbent fights back, the innovators, the builders, will come up with a better solution, and that's what's fun, right? And that's the whole idea of innovation as an asset class is what gets me out of bed every day, and investing capital alongside and behind incredible innovators and builders is just the greatest thing ever. It just is. So. Happy 200. Congratulations on everything you and Yano and the rest of the crew at Blockworks have done to build such a incredible franchise. I am privileged to be part of it. Love doing this every week. It's great discipline, which is part and parcel of success, is having some discipline. But it's also it's great to take time once a week to think about big ideas and to have dialogue and debate in search of truth. And you do that better than anybody I know. So Socrates would be proud.
Thanks, Mark. Appreciated. All right. I will see you here same time next week. Cheers,
All right.
my friend.
See you then.